Hello, everybody. Good morning. Beautiful day we have here in New York. Beautiful, cold November day. We're here to talk about how stocks and crypto are colliding in 2026. We've all seen this, we've experienced it, and we have some great operators and experts with us today to really unpack what does this mean for all of us in fintech. So on this panel today, well, first I'll introduce myself. My name is Katie Perry. If you came here for a concert, you were not in the right place, but I am going to be moderating this panel. I'm a fintech marketer, and I also host a market news show for StockTwits. Here on the panel today, though, I'm really excited. To my left, Adi Nishandar, CTO of NinjaTrader, Ankit Shah, Global Head of FinTech at GTN, and Michael Terrapin, Founder and CEO of Transform Group. So we're going to get into this topic here. But real quick before we start, let's go down the line and give a quick, 1 minute explanation, who you are, how you fit into this narrative, sort of set up the context for our audience here today. I'll start with you, Adi.
Yeah, thanks, Katie, for having me on the panel. Adi Nishandar, I'm the CTO of NinjaTrader. We are the leading retail futures active trading platform, and the whole world of tokenization is actively impacting how we are thinking about active traders and this market. Over to you, Ankit.
Hi, my name is Ankit Shah. I'm the global head of fintech for GTN Group. GTN is basically a fintech-powered brokerage firm that provides access to global equities, ETFs, bonds, funds, etc. And we specialize a lot on the fractionalization space, crypto, and the collision between equities is a very interesting space that we have been observing.
Hi, I'm Michael Turpin. I've been in TradFi for 30 years, but in crypto for the last since 2012, early 2013. I'm noting, of course, the emergence of TradFi and institutions into crypto, and it's often judged by the inflows and outflows of the ETFs. I judge the interest today on the inflows and outflows of the audience, which I think we had about 30% more outflow after the last panel than inflow. So we're still early. At any rate, I wrote...
They'll be back. There's getting some coffee.
I wrote a book last year, which I had launched at this event last year, Bitcoin Supercycle. It's done well on Amazon. Simon & Schuster distributes it. And I predicted in here when we were going to hit the new all-time high last year. I said a Trump one would be early November, and it was, Election Day. And I'm still one of the few people that says we are still in a bull market, and I think I got some good evidence of that today.
All right. Great. It's great to have all you guys here. Obviously, we're talking about the convergence of TradFi and DeFi, and even Michael talking about your background, meeting more and more people who are building in the crypto space who have that background, sort of coming in from the old world. We're also seeing this in the convergence of companies. Adi, NinjaTrader was acquired by Kraken recently. So I want to hear from your point of view, how are retail trading habits and their funding expectations changing as these two markets are colliding? What are you seeing at NinjaTrader?
Yeah, I think this year was a pretty momentous year for NinjaTrader. We got acquired by Kraken, one of the biggest deals in the TradFi and crypto space. And the thesis is pretty straightforward. Kraken has 15 million plus customers. NinjaTrader has 2 million and counting customers, and these are active traders. And combining, a lot of people are going full crypto, but Kraken's strategy has been combining TradFi and DeFi and meeting people where they are. I think what we're seeing with traditional finance and what crypto brings to the table is this traditional finance active trader market, which NinjaTrader serves, has been, funding cycles are really long. It takes really long to open an account, fund an account. When you see action in the market, and with the Genius Act and stablecoin innovation that is happening, we are really seeing how the funding rails are changing, and crypto is leading the way there.
And quick follow-up for you, and I want to dive more into the stablecoin thing, because I feel like that word and tokenization, I think if you drank coffee every time you heard those today, you might not make it out of here alive. But in terms of, from the technical side, what's the biggest infrastructure consideration or challenge when you're bringing these two worlds together? Because it sounds like the rails that crypto is built on and TradFi are very different. So I guess in layman's terms, how are these coming together from a technical point of view?
Yeah. I'm an engineer at heart, so this is very close to me. I think from a technical point of view, if you think about how funding happens traditionally in NinjaTrader is a regulated entity. Not many people know, but we are an FCM. So we have to have segregated funds. They have to be held in a separate account. We typically fund through traditional means, ACH, wires, now RTP, and all of that is like, traditionally takes 1 or 2 days, maybe even getting faster, but it's 1 to 3 days. I just funded my crypto account with stablecoin yesterday, and took me less than 4 seconds to do that. And what that enables us, and especially around, crypto is a large, has a wide variety of asset classes. You have the Bitcoin, whereas now with stablecoins, the friction to fund and move money is extremely getting demolished, and what that means to finance in general, the on-ramp of how you can fund something with stablecoin, and when we get regulatory clarity there, what that means to trading and investing, that's just fascinating. So from a technical point of view, the rails are already there. We just have to get regulatory clarity on how those rails will impact traditional finance.
We got started on that in July with the Genius Act, and I know in Europe they have MiCA. Ankit, I want to talk to you a little bit about sort of the expectation of users. You represent and work on behalf of a lot of retail traders globally. And this concept of tokenization is really interesting because I think you see just with the merging of cultures and social media, there's this appetite in a lot of markets for investing in US companies. It's been very difficult to do in the past, both from funding, but just a regulation or access standpoint. So what does tokenization make possible for these global audiences that do want to invest in US-based companies?
So I think if you look at the concept of tokenization, right, it's where you are putting a financial asset on chain and you're allowing people to transact on it, right? There are two types of methods which you can do this. One is the public chain, one is a more permissioned chain. And one of the challenges that we have today is, if you look at crypto, it's pretty much on the public chain, right? But when you talk about stocks, if you try to put those onto the public chain, it's technically not yet possible. So they're more on permission chains where they are kind of inside a guardrail. For example, like Kraken has launched that. Similar to that, there are other companies that are looking at doing it as well. What's going to happen at a future stage is where you'll see more and more regulators adopting the ability to take these stocks and putting them on chain. So from an infrastructure point of view, you will see a lot of expansion into the adoption of tokenization across different regulators as well.
And when you think about tokenization, so is that the tokenized stocks is an interesting conversation. I know there's some even private companies in the US kind of pushing back and saying, wait, we don't want that, but it is primarily for a global audience. So is the regulation going to come from, do you think, the jurisdiction where the companies are in the US, or is that going to come from global markets based on what you're seeing?
So I think if you look at the most recent regulation, there's Project Guardian. It's not a regulation, it's more of a project that was started by the Monetary Authority of Singapore, where they actually are trying to adopt tokenization. So there are a couple of funds. I think Fidelity had launched a couple of funds on chain, and they were allowing, they've run a couple of tests where you can actually transact on the funds on chain, and that allows you to effectively purchase and sell pretty much instantaneously. One of the biggest challenges in different asset classes as well exists, right? Like, for example, if you're buying a mutual fund, settlement cycles are not even T+1, they're T+6, T+7. So imagine if you can bring that down to almost instantaneous, right? So that is that is the space where you will see a lot more regulators adopting the on-chain method.
Right. And Michael, let's zoom out a bit, the macro view. You've been following these cycles. You've written extensively about them, tracked them for over a decade. How is institutional adoption, so whether it's ETFs or banks issuing stablecoin, how are these players changing the traditional four-year market rhythm that you describe in the book, if at all?
Sure. So far, they haven't changed it at all in terms of the timing of the cycle, but they certainly have changed it in terms of the velocity. So in other words, there's no way that Bitcoin gets to $1 million, which it will. I think it's a when and not an if at this point. But you need to have larger players. And a lot of times it's just to enable retail to feel safe, right? So when they say, oh, there's, X hundred millions of dollars, streaming out of BlackRock or streaming into Grayscale, it's not these institutions buying it and putting it in a safe. It's because their clients are buying it. And they're typically acting like, I'll say dumb money. They're acting like first generation retail. They're acting like Dogecoin holders did 4 years ago. And when the price goes up, pretty much guarantee you there'll be ETF inflows today. And then when the price goes down, they panic sell, which is not a good way to make money. But for the most part, the 4-year cycle has been one of the most consistent things in the history of Bitcoin, and it's based on the halving. Satoshi said in the white paper that as long as the amount of Bitcoin bought during any 4-year period exceeds the amount mined, which gets cut in half every 4 years, the price has to go up. It's supply and demand. That doesn't mean it goes up in a straight line, and that's where all the volatility has happened in what I call the 4 seasons of Bitcoin, and that's in my book. And it's been very consistent. Bitcoin spring, miners are losing money, price stays flat because people are happy to pick up when it drops, but they don't buy a lot until all of a sudden, new all-time high, Bitcoin summer, shoots up like a rocket ship. That's where we're in now. Usually goes up at the start and at the end. We're not at the end yet, and then the bubble pops and it drops. 85% drop the first halving, 83%, then 75% last time. One of the heads of the ETF said it's actually going to be always up from here, lack like gold, no more than a 5% drop. That is just nonsense. That's a 6,000-year-old asset class for gold. We're going to still see about a 2/3 drop. Once we hit the top, and we have not hit it yet, I'm still on record as saying I think it's going to be between 150 and 220, which is 3 times the halving plus or minus 20%. And we aren't done with the fourth quarter yet.
So that's your prediction for the end of the year.
End of the year, it's possible because of the government shutdown that it could stream into early 26, but everybody said it's going to be a 5-year cycle. Is this wrong?
Okay, let's talk quickly about the culture clash of these two worlds, because one thing I think we talked about in the prep call a little bit that's fascinating is you have the hardcore crypto builders and holders that have a sort of, many of them have an anti-establishment sort of angle, and now you have the institutions by and large buying in across the board. They're investing in companies, they're building their own infrastructure. Michael, you've been on both sides of this, and you've written a whole book on Bitcoin. What's your assessment of how these cultures are merging, and how can companies operating in this space better collaborate?
The earliest of the early, right? The people who got into Bitcoin in the first 2 cycles, which is where almost 2/3 of it was mined. They typically came in when it was worth a penny or a nickel or $1, in my case, $100. And, they typically came in from a libertarian perspective. They read the cypherpunks who said, mathematics and privacy can separate money from state, like it used to be back when it was, gold, not coinage, and certainly not fiat currency. And so I remember seeing a quote that was widely agreed upon in my community, which is, we have not come this far to have people buy Bitcoin from BlackRock, right? But on the other hand, it's like a number of these, whales, when they decide they want to cash out something, they're doing OTC deals to BlackRock. So, it's something that happens in every emerging asset class. You have Jeffrey Moore wrote about it decades ago in the Crossing the Chasm. What the earliest 3 or 4% in any asset class want is very different than what it takes to go mainstream.
All right. Do you have any theories about who Satoshi is, by the way? I'm always curious to ask.
Yeah, I still think there's a very good chance that Craig Wright is part of Satoshi, even though he's been a bit of a blowhard and he had a court saying that he's not Satoshi, but the courts have been wrong.
The mystery goes on. Let's bring it back down a little bit, because I know a lot of you guys are operators, builders in this space. I want to talk a little bit more about the infrastructure. Adi, back to you. We talked a little about how stablecoin could really transform funding. We were talking earlier about, tomorrow's a bank holiday, but the market's open. All these things make a disjointed experience as things are now. For not just the tech, but sort of compliance, risk management, you're working with integrating within Kraken now. What are some considerations that companies should have if they're sort of building both of these worlds within a single interface?
Yeah, I think it depends on your point of view, NinjaTrader is a regulated entity, so we obviously look for regulatory clarity from the regulators. The United States traditionally has been lagging behind regulatory clarity on crypto and in general the digital assets, but we are getting more and more clarity now. Kraken, one of the reasons why Kraken launched their stocks, X-stocks, tokenized equities was outside the US because we are still waiting on regulatory clarity there. So I would say as operators and builders are building in this space, as you're merging traditional finance and the digital assets world, I think it's making sure that you really understand and work with your regulators and your compliance to push the regulators, but at the same time understand what's acceptable and what's not. One of the areas where we are working with our partners is to understand the ability to, instead of holding US dollars, can we hold stablecoin, things like that. So I think it's working with the regulators and then be as compliant as possible. One of the first things that we are working with Kraken is that a lot of the times the regulations is more clear. Like Kraken has a MiCA license now through Bank of Ireland in the EU. So what can we do there, bringing traditional finance and digital assets out there versus the United States? Those are different aspects that you have to be clear about when you're building things.
And with MiCA, you get regulated in one jurisdiction within there, and then you're eligible to operate in all 30 countries or nations within this sort of European economic zone.
Yeah, I think if I'm not mistaken, the MiCA license is through Bank of Ireland, and I think that gives us access to the multiple countries.
All right, let's keep it on the global perspective. Ankit, I'm curious in a couple things. We're talking about this sort of hybrid infrastructure, global audiences of investors that you build for. Is this the expectation now that all these things are in one place? I guess in emerging markets, are they more likely to bifurcate the two experiences, or are they more likely to kind of envision them as one central trading experience that they're looking for?
So I think if you look at from a global perspective, right, if you think about a person sitting in Thailand or sitting in Vietnam wanting to trade into the US markets, right now they have to open an account with a retail broker. Then they have to wire money to the US. Then they have to purchase a stock, right? They wait for settlement and they own the asset. Imagine a situation where they would be able to, basically fund it with a USDC and be able to purchase the stock pretty much instantaneously. That can bring the time down quite a bit. So I think the expectation from a global audience is to be able to consolidate and be able to, the concept of instant gratification, right? A lot of people, like in the US, to invest in a US stock is very straightforward. It's very easy. Globally, it may not be so. And that's what I think, this infrastructure can potentially bring, allowing somebody sitting in Africa or sitting in Thailand or sitting somewhere in the Middle East to be able to access these markets very seamlessly and very easily. That's not to say that it is not the case today. There's been a lot of change and improvement even in the traditional financial space, but I think this can catapult it to the next level.
And on the global front too, a lot of the stablecoin, you talk about the speed of funding. Let's talk about the democratization potential for that. Somebody who might not have a traditional bank, like what does stablecoins unlock for somebody in an emerging market that might not have the same sort of infrastructure, perhaps on their phone or somewhere else?
So I think one of the things that you can look at is the fact that, for example, GTN specializes a lot on the fractionalization space, right? So fractionalization of US equities is pretty commoditized. Fractionalization of certain other markets is commoditized as well. But the ability to fractionalize practically any financial product and offer it on chain is something that is potentially a reality with this infrastructure. So when you talk about democratization, making access available for being able to invest a really small amount into a larger financial asset class can be potentially possible through this, whether it's a large bond, whether it is a structured product that requires a large minimum ticket size, right? So all of those, again, potentially can become a reality over a period of time.
Yeah, Michael, I want to ask you, I mean, you wrote a book about Bitcoin, and a lot of what we're talking about is kind of on another aspect of crypto, but how are these things sort of living together, feeding off each other? For example, increased desire for institutions to get in on stable coins. How does that impact Bitcoin at all, or if at all, or is that sort of a self-existing ecosystem?
Well, they're all on chain. That's the thing that links them all together. And eventually the entire world's going to be on chain, just like 30 years ago, nobody was on the internet. And now the entire world's on the internet. The entire world's on mobile. There was always this question about how can we get, the pipes into Africa? Well, we didn't need pipes. We just, went over and just put cellular. And so in the same way, in many of the places that, there's still a couple of billion people in the world that have no access to the traditional banking system. And this is all solved by them basically having access to Bitcoin, to stable coins. I think in the global south, you're finding that, and this will increase, that the typical person is going to have their savings account in Bitcoin and their checking account in stable coins, and the movement between them. I mean, they used to have to spend Bitcoin because they didn't have stable coins. Now they do.
Yeah.
Maybe one more thing, right? So if you look at the traditional infrastructure of the banking side, right, it's all based on SWIFT. Cost of moving money. So again, if you're looking at investing in the US, right, the cost of moving money is so expensive for a person making an investment as little as, let's say $500 or $1,000. They're paying maybe $20, $25 to move money abroad, right? And plus they're paying the FX conversion rates. That also can get democratized in a big way. So just to add into what Michael was saying.
Yeah.
All the banks, they're all incented to basically not only embrace Bitcoin, but to embrace stable coins in a big way. Arthur Hayes, who's a very well-known entrepreneur in the ecosystem and a brilliant writer, had said in his blog a couple of months ago that he thought that all of the too big to fail banks were going to go and get rid of cash and make it all stable coins, and they could save like enough in compliance costs, because it's like, hey, it's here on chain, and like fire 20 or 30% of their workforce, that their stocks would go up 60% on average.
Yeah, I mean, that's an interesting point with stablecoins, because the immediate thought, if you've kind of been at the other side of these, is like the banks are collecting fees on all these transactions, but to your point, the cost savings on other things seem
they will collect big fees if they are all stablecoin, because they're going to say, hey, instead of us giving you 0.05% interest, we're going to give you 2% interest on stablecoins, and they'll go make 10%.
Yeah. Let's talk about this retail institutional feedback loop, because we're talking about the convergence of crypto and traditional finance, but you also have this sort of blurring or intersection between retail and institutional. For you, Adi, retail traders are really pushing institutions to adopt and adapt some of these changes, both on things happening in the back end, the speed at which funding happens, but also on things like UX and other features. How are institutions sort of tracking or monitoring the demand from retail traders and sort of evolving in kind? How do you guys see that at NinjaTrader?
Yeah, I mean, we're seeing this movie play out like day in, day out, where the active trader, the retail trader, they're getting more and more sophisticated. When 15 years ago, I was at Goldman's trading desk, the software we had out there is now in the hands, and even better in the hands of, through NinjaTrader and other providers, in the hands of retail consumers. They're well educated. A lot of times, algorithmic trading was thought to be very specialized institutional thing, but now with LLMs, you can just write scripts and bots, and there are just videos, and you can follow YouTube videos. So the flow, the retail trader is more and more active traders, retail traders are coming into the market, which means that more volume for the market makers and more volume on the institutional side. So the institutions have to react to the retail trader because they are driving a lot of volume and demand. One classic example, I think there's a panel later on, is prediction markets, which is a hot topic right now, which is institutions, if you were to, like, the retail trader is pushing for a Sunday night football game getting funded so that they can put like sports or prediction market bets on Kalshi or Poly markets, and the institutions would have never they would have never done that. But the retail trader is pushing that, and the institutions have to adopt to that, and that's how I think the evolution is going to happen.
Maybe just one more point, right? So if you think about historically, a retail trader wanting to run an algorithmic trading strategy would have to know how to code, would need to know how to effectively connect into the API infrastructure of a broker, and etc. Today, most of the brokers, you can actually just prompt ChatGPT and tell ChatGPT, build me the strategy, tell me how to connect, and it actually writes the entire thing. And if you are slightly smart enough, you can actually take it on and switch it on much faster than you would have been able to maybe just a couple of years ago.
Yeah. And these are becoming embedded. I talked to Vlad Tenev from Robinhood a few months ago, and he was insinuating maybe some sort of agentic AI flow where you train, they're investing. I think they have an AI event coming up, Robinhood, but almost programming it to make to be your brain and make the decisions for you, which is a wild to think about. Michael, I want to turn to you and kind of wrap this all together. Closing thoughts from you. You seem to make a lot of predictions. You seem to be right a lot. So in one sentence or thought, by the end of next year, what is a headline you would hope to be reading about the convergence of stocks and crypto?
Wow. Well, we have very different cycles, right? They've been predicting that the bubble's going to pop in AI for a couple of years, and the stocks just keep on going up. I mean, the stock market is much more reliant on earnings, on monetary policy. They're all reliant on sentiment, and there are different types of sentiment. Google's up 60-something% this year. Nvidia's up 40%. Bitcoin's only up 11, 12% right now, whereas they're up 120% last year, and none of the, Mag 7 were up that much. So I believe that, we are historically, Bitcoin's been about 60% uncorrelated to the stock market. In more recent years, it's probably flipped a little bit and been about 2/3 correlated to the NASDAQ. But, it's becoming more mainstream with institutional investment, just the size of the asset class, the types of investors. But we're still really early. There's only 5% of the entire world has even $1 of Bitcoin. And yet 95% of the Bitcoin has already been mined, and the last 5% will take over 100 years.
Wow.
And so, that means that when we get to the point where we're at 20%, where's that Bitcoin going to come from? It's going to come from price discovery, and that's when you get to $1 million Bitcoin. So, I guess I don't think next year we're going to be at $1 million Bitcoin. I think it'll be about 8 years. And we will have a crash before that. We'll probably have a lot lower price Bitcoin next year than we have today.
All right, we'll check in with you within 8 years. Ankit, how about you? Headline, sometime in the next year, do you want to see about these two worlds converging that perhaps support what you're building at GTN?
Yeah, so I think the headline I would want to see is that regulators are paying a lot more attention to this space. Mass has done a great job in the US. You have the Genius Act as well. I think once you will see more and more regulators adopting this, you will be able to see a lot more digital assets coming. I mean, a lot of traditional assets coming into the digital asset space and being on chain and making them available to a much wider audience. And hence, potentially, volumes will go up. Brokers like us would do very, very well.
All right, Hadi, how about you? You're going to have your hands full, it looks like, with this integration. Really exciting times to be at NinjaTrader. What would you like to see happen in the next year?
Yeah, I think the retail demand is going to rise. It's going to be constantly increasing. I would love to see US be leading the charge on tokenization. It's not a matter of if, it's a matter of when real world assets gets tokenized. So I would see that happening earlier than later.
A lot of global arms race happening with tokenization, AI. Thank you so much, Michael, Ankit, and Adi. Thank you to everyone for joining. Want to give a quick housekeeping item. I hope you're all finding the sessions interesting so far. We have a break for lunch coming up next, sponsored by Apex Trader Funding. It's going to be served down the hall in Gallery 2 and downstairs in Gallery 1. So you can use this time to network, visit sponsors, upload pictures, tag Benzinga, all the good things. Thank you again to our amazing panelists, and thank you to you all for joining us today.